Back in 2008, the entire global economy was pushed to the very brink of collapse. It was the worst financial crisis since the Great Depression, and believe it or not, it all started with something that looked like a really good thing, a huge boom in the US housing market.
And that's the big question we're tackling today, isn't it? How on earth could something as wholesome as the American dream, people buying homes, set off a chain reaction that brought down financial giants and sent the entire world into a massive recession? Well, to figure that out, we've got to look at how the whole thing was built in the first place. So here's how we're going to break this all down. We're going to look at it in 5 key stages. We'll start with the conditions that created this perfect storm. Then we'll find the spark that lit the fuse. After that, we'll see how Wall Street built a machine to spread the risk. Then we'll watch the dramatic collapse. And finally, we'll look at the aftermath and the aftershocks that, honestly, we're still feeling today.
All right, first up, the perfect storm. And I mean that because this crisis didn't just pop up overnight. Nope, this was the result of a few really powerful forces all coming together at exactly the right time to create the perfect conditions for a total disaster. The scene gets set in the early 2000s. See, after the dot-com bubble burst and the 9/11 attacks, the US central bank, the Fed, really wanted to get the economy moving again. And what's their main tool for that? Making money super, super cheap to borrow. You combine that cheap money with really relaxed rules for getting a loan, and boom, you get an absolute frenzy in the housing market. And just look at how crazy this was. The Federal Reserve took its key interest rate and just slashed it from over 6% all the way down to 1%. That is not turning on a garden hose. That is opening a fire hydrant. This absolute gusher of cheap money just fueled this mad dash to buy houses. And prices started to go through the roof. So all that cheap money basically created a giant financial tinderbox. Now we get to the spark that lit the whole thing on fire: subprime mortgages. This was the first domino. It's actually a pretty simple 4-step recipe for disaster. First, the Fed drops interest rates. Then, that cheap credit kicks off a home buying frenzy. So to keep that party going, lenders basically start throwing the rulebook out the window, loosening their standards like crazy. And that just opens the floodgates for what we call subprime mortgages. These are loans given to people who, in any normal time, would have had zero chance of qualifying. And this quote right here, it really nails it. This wasn't just about making it a little easier to get a loan. We're talking about people with bad credit or no credit history getting mortgages for homes they had absolutely no realistic way of ever paying back. The entire system was built on one single, incredibly fragile bet that housing prices would just keep going up forever. Spoiler alert, they didn't. So, you might be wondering, how did a problem with some shaky US home loans turn into a global catastrophe? Well, this is where Wall Street comes in. They essentially built a financial machine that took this one local risk and just sprinkled it all over the entire world. The key to this machine was an invention called a mortgage-backed security, or MBS. The easiest way to think of it is like a financial sausage. Investment banks would go out and buy up thousands and thousands of individual mortgages, the good ones, the bad ones, the really ugly ones, and then they'd grind them all together and stuff them into a brand new package. Then they sold slices of this financial sausage to investors all around the globe, promising them a really nice return. Yeah, the fruitcake analogy is just perfect for this. The risky subprime loans were like those weird, chewy mystery bits you find in a fruitcake, right? They were mixed in with all the good stuff, the safe prime mortgages. But here's the problem. The whole thing was sold as this delicious, totally low-risk cake, even though it was secretly packed with all these toxic ingredients. And then the machine went into total overdrive. Regulators let the biggest investment banks borrow insane amounts of money to buy even more of these mortgage products. This is called leverage. We're talking about them making bets that were 30 or even 40 times bigger than the money they actually had. It was like betting your entire life savings on a single hand of poker. And sure, while the housing market was booming, the profits were enormous. But it also meant that if those mortgage-backed securities lost even a tiny fraction of their value, the entire bank could be instantly wiped out. And that is exactly what happened. The moment housing prices started to wobble and people started defaulting on those loans, the whole house of cards just came crashing down. So, welcome to September 2008, the month the dominoes really truly fell. Just look at how fast everything fell apart. The first tremors hit in 2007 when the original subprime lenders started going bankrupt. Then, in March of 2008, a Wall Street giant, Bear Stearns, just collapses. By September, things are so bad the government has to seize Fannie Mae and Freddie Mac, the two biggest mortgage companies in the country. And then just days later, Lehman Brothers, an investment bank that had been around for over 150 years, was gone. It filed for the biggest bankruptcy in U.S. history. At that moment, the entire global financial system just froze solid. But this wasn't just about numbers on a screen on Wall Street. The collapse had absolutely devastating real-world consequences. Almost 4 million American families lost their homes to foreclosure. The fancy financial engineering happening in New York City led to real for sale signs on lawns all across the country. So, who do we point the finger at for this whole mess? Well, the truth is there was plenty of blame to go around. It was a whole chain of irresponsibility. You had predatory lenders pushing loans on people they knew couldn't afford them. You had the investment banks bundling up all that risk into those toxic fruitcakes. You had the rating agencies, the guys who were supposed to be the referees, stamping these dangerous products with a perfect safety score. And you had investors who were so busy chasing profits, they just bought them without asking any tough questions. Okay, so what happened next? In the wake of this spectacular collapse, the focus immediately shifted to two things: preventing a complete economic depression and trying to make sure something like this could never, ever happen again. To stop a complete and total meltdown, the U.S. government stepped in with a massive and hugely controversial bailout plan called TARP. Now, the idea of using taxpayer money to go save the very banks that caused the crisis was, to put it mildly, not popular. But the government gambled that it had to be done to avoid a second Great Depression. And here's the part that's often forgotten. In the end, the government actually got all that money back, and then some. The biggest long-term change was all about the rules of the game, regulation. Before the crisis, you had this environment of really loose rules and not much oversight. Afterwards, a huge piece of legislation called the Dodd-Frank Act was passed to rein in the banks. It basically restricted their riskiest activities, ramped up government oversight, and forced them to keep way more cash on hand to absorb any future losses. And all of this leaves us with one final, kind of unsettling thought. The specific details of the 2008 crisis might have been unique, but the basic pattern, it's as old as markets themselves. New technology, human greed, and that dangerous belief that this time is different have been inflating and popping bubbles for centuries. The rules put in place after 2008 were designed to stop that exact crisis from happening again. But the real question is, what's the next blind spot? What new innovation, or just old-fashioned greed, is inflating the next bubble right now?